You've paid taxes your entire life on every paycheck, every bonus, every investment gain. So when you finally reach retirement, you expect that what's left is yours. But here's the surprise most retirees never see coming. The IRS can still find a way to tax the same dollar twice legally. You see, retirement isn't just about how much money you've saved, it's about how you withdraw that money. Because depending on the types of accounts you use, the order you draw from them, and even how your income is reported, you could be triggering multiple layers of taxation, all on the same pool of money you've already earned. For many retirees, it happens so quietly they never even realize it. A withdrawal from an IRA or 401k raises their taxable income. The higher income makes more of their Social Security taxable. And then to make matters worse, it pushes their Medicare premiums higher, all from a single withdrawal. So while you think you're just taking income for living expenses, the IRS is taxing that same money 2, sometimes 3 different ways. Today we're going to break down how this trap happens, why it's so common, and most importantly, how to structure your withdrawals so you don't fall into it. Hi, I'm Josh Bliss, founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. If you find this kind of content helpful, make sure to like this video, subscribe, and comment below with your biggest question about retirement taxes. And if you want to make sure your own retirement plan isn't quietly overpaying the IRS, you can book a free consultation using the link in the description below. We'll look at your income, Social Security, and withdrawal strategy and show you how to coordinate them for maximum efficiency. Now let's walk through exactly how retirees end up paying taxes twice on the same dollar and how to avoid it. 1. Where the double tax problem begins. When you contributed to your traditional 401k or IRA, you got a nice benefit. Those contributions were made before taxes. That means you didn't pay income tax when the money went in. But here's the trade-off. When that money comes out, every dollar is fully taxable as ordinary income. That's not the issue. The issue is what happens next. When you take income from those accounts in retirement, it doesn't just affect your taxes on that withdrawal, it also affects how much of your Social Security becomes taxable and whether your Medicare premiums increase. So one decision, like taking $20,000 from your IRA, can have a ripple effect that causes you to pay taxes on multiple layers of your retirement income. 2. The classic example. IRA withdrawals and Social Security. Let's say you're receiving $40,000 a year in Social Security benefits and you withdraw $30,000 from your IRA for expenses. Here's the trap. The IRS uses something called provisional income to determine how much of your Social Security is taxable. Provisional income includes your adjusted gross income, including IRA withdrawals, plus half of your Social Security benefit, plus any tax-exempt interest from municipal bonds. Once your provisional income crosses $44,000 for a married couple or $34,000 for a single filer, up to 85% of your Social Security becomes taxable. So in this example, that $30,000 withdrawal doesn't just get taxed itself, it makes a larger portion of your Social Security taxable because of that withdrawal. That's the first double tax hit. The same dollar triggers multiple layers of taxation. 3. The hidden layer, Medicare IRMAA surcharges. But it doesn't stop there. The next layer shows up in your Medicare premiums, specifically through something called IRMAA, which stands for Income Related Monthly Adjusted Amount. The higher your income, the more you pay for Medicare Part B and Part D. If your modified gross income exceeds $206,000 for a couple or $103,000 for an individual in 2025, you start paying surcharges. Those surcharges can add hundreds or even thousands of dollars per year to your healthcare costs. And here's the kicker. Those income thresholds are based on your tax return from 2 years earlier. So a larger withdrawal in 1 year could raise your premiums for the next 2 years. That means a single IRA withdrawal can hit you 3 times. 1, it's taxed as income. 2, it makes your Social Security more taxable. 3, it raises your future Medicare premiums, all from the same money. 4, the state tax layer. If you live in a state that taxes retirement income, you could face a 4th layer. States like California, New York, and Oregon tax IRA and 401k withdrawals as ordinary income, and most also include your taxable Social Security in that calculation. So if your withdrawal triggers more taxable income at the federal level, your state could take a cut too. When you add that all up, you're not just dealing with income tax. You're dealing with income tax, Social Security tax, Medicare surcharges, and possibly state tax, all cascading from one decision. 5, the RMD effect, why it gets worse with age. Once you reach age 73, you're forced to take required minimum distributions, also known as RMDs, from your retirement accounts, whether you need the income or not. Those mandatory withdrawals can easily push you into a higher tax bracket, trigger Social Security taxation, and bump your Medicare premiums all automatically. That's why retirees often tell me, my income didn't really go up, but my tax bill did. It's not that they earn more, it's that the system forced them into higher taxable income. 6, how to avoid the double tax trap. The good news? This is completely avoidable if you plan ahead. There are 3 key strategies. A, diversify your tax brackets. Don't let all your money sit in pre-tax accounts. Having a mix of taxable, tax-deferred, and Roth accounts gives you flexibility to control your income in retirement. That flexibility helps me manage taxable income and avoid unnecessary Social Security taxation. B, take advantage of the tax window between 59.5 and 73. Those years before RMDs begin are critical. If you can strategically draw down pre-tax accounts or do partial Roth conversions during this window, you can lower your future RMDs and reduce the chain reaction that causes double taxation. C, coordinate withdrawals, Social Security and Medicare. Don't make these decisions in isolation. When to claim Social Security, when to start Medicare, and which accounts you pull from all work together. A coordinated plan can help you stay under key thresholds and avoid triggering taxes or surcharges unnecessarily. 7, the bigger lesson. Most retirees assume tax planning ends once they stop working, but in reality, retirement is when tax planning matters most. You're no longer earning new income, you're managing the taxes on what you've already earned. And the difference between a coordinated plan and a reactive one can be tens or even hundreds of thousands of dollars over your lifetime. Avoiding the double tax trap isn't about loopholes or beating the IRS. It's about understanding how the rules interact and planning accordingly. So here's the takeaway. The IRS isn't trying to trick you, but the system can punish those who don't plan ahead. If you're approaching retirement and want to make sure your plan isn't quietly paying taxes twice on the same money, click the link in the description below to book a free consultation. We'll walk through your accounts, Social Security, and withdrawal strategy to identify where hidden taxes could be waiting and how to prevent them before they happen. And if you're ready to take advantage of the tax window between 59.5 and 73 and dive right in to implementing a Roth conversion, please see the additional link below for my complimentary Roth conversion playbook. It gives you clear, sequential steps on how to execute your own personalized Roth conversion. And lastly, if you want a more detailed, personalized analysis of your own Roth conversion schedule, please mention this in the comments section when downloading the Roth conversion playbook. This is an invaluable tool which will show you how much of your IRA you should convert in each year, and most importantly, a detailed breakdown of how much you will save in taxes over your expected lifetime. Thanks for watching, and if you found this helpful, don't forget to like, subscribe, and share this video with someone who's getting ready to retire. Because in retirement, keeping what you've earned is just as important as earning it in the first place.